Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
$375.22. That's the number on the board as we close out the session today, Tuesday, February 10th, 2026. We're looking at a daily decline of 2.16%.
On decent volume, too. 18.29 million shares changed hands. And honestly, if you're a Micron holder, you're probably breathing a little sigh of relief that it was only 2%.
It has been a rough week.
Rough is an understatement. You have to contextualize today against the absolute bloodletting we saw on February 4th. That was a 9.55% drop in a single session. The stock opened at, $410.59 and just slammed shut at $379.40. I mean, investors are still licking their wounds from that one. The volatility isn't just a feature right now. It's becoming the whole narrative.
Look, it's volatile, I'll grant you that. Of course it is. But let's not lose the forest for the trees here. Even with this recent consolidation, and I'm deliberately calling it consolidation, not a crash, Micron is still sitting on a 12-month gain of, 298%? We hit a record high of 455.50 just recently. The question we are tackling today isn't about the last week of trading. It is about the next decade. Is this pullback to the 375 range a distress signal? Or is it the entry point for what could be a five-fold increase in valuation?
Well, that is the trillion-dollar question, isn't it? Literally, you see a discount on a future giant. I see a market finally waking up to the reality that supercycles eventually face the gravity of cyclical risks. We are looking at a stock that is pricing in, perfection, while facing very real, very technical hurdles with the NVIDIA Vera Rubin platform. You just can't ignore gravity.
I see why you'd focus on the technical hurdles, and we will get to those. But let's look at the valuation disconnect first. The market is treating Micron like it's 2018 again, ignoring the structural shift in what this company actually does. We are looking at a forward 12-month PE ratio of 10.24. Compare that to the sector average of 25.06. I mean, that's a huge gap. Investors are buying high-margin AI infrastructure for 10 times earnings. That has Barman been pricing for a luxury asset.
Hold on. A low PE can be the ultimate value trap if the earnings, are at a cyclical peak. You know how this works. In semiconductors, specifically memory, the PE is always lowest right before the earnings collapse.
But are we at a peak? That's the assumption I challenge. Look at the fiscal Q1 2026 results from November 2025. Revenue was up 57% year over year to $13.64 billion. But the number that matters, the number that tells me this time is different, is the non-GAAP gross margin, 56.8%. We are heading toward guidance of 68% for the next quarter. This isn't a commodity cycle anymore. This is specialized, high-margin infrastructure. The high-bandwidth memory, or HBM, capacity is entirely sold out for calendar year 2026. The demand isn't softening, it's hardening.
The financials are undeniably strong right now. I'm not disputing the $13.6 billion or the margins today. What I am disputing is the assumption that this trajectory is a straight line up and to the right. You mentioned the PE ratio. The market often discounts cyclical stocks at the top of the cycle because it anticipates the fall. And there is reason to be anxious. The price for perfection anxiety is real because Micron is, currently stumbling in the race that matters most.
You're referring to the qualification reports regarding NVIDIA?
I am. Early February reports, multiple sources, indicate Micron is behind. Specifically, regarding the HBM4 qualification for NVIDIA's next-generation Vera Rubin platform. For the listeners who might not follow the engineering roadmap, HBM4 is the next evolution of memory stacked directly onto the GPU. It's the engine room. And right now, Samsung and SK Hynix are reportedly ahead. If you miss the qualification window for the flagship AI accelerator, you are the infrastructure, you are the backup plan.
I think backup plan is a gross exaggeration. You're making it sound like they've been kicked out of the building.
Is it, though? The reports suggest Micron is pivoting to provide LPDDR5X, the SOKM2 modules, for the CPU portion of those systems. Let's break that down. LPDDR5X is low-power memory. It's what you find in your phone or a high-end laptop. Putting that on the CPU side of an NVIDIA server is great, sure, but it is a consolation prize. the high margins, the pricing power, the AI premium, that lives in the HBM stacked on the GPU. If they lose the lead there, that valuation premium you mentioned just evaporates. They become a side dish, not the steak.
I disagree with the characterization of the pivot. It's not an either-or scenario. It's a portfolio. But before we get into the weeds of HBM4 and the specific engineering timelines, we have to talk about the broader strategy. Micron isn't just reacting. They are restructuring the entire business model. And nothing signals that more clearly than the decision regarding Crucial.
The decision to just kill the brand?
The decision to focus. In December 2025, Micron announced the discontinuation of the Crucial consumer brand effective this month, February 2026. For 30 years, Crucial was the face of Micron to the average consumer.
It was iconic. I mean, if you built a PC in the last 2 decades, you probably bought a stick of Crucial RAM or a Crucial SSD.
Exactly. But killing it was a ruthless and I think necessary strategic pivot. It signals that Micron is no longer a consumer hardware company.
It was certainly surprising and risky.
It shouldn't be surprising if you look at the math. The Cloud Memory Business Unit, CMBU, posted 66% margins in fiscal Q1. Compare that to the razor-thin margins of selling SSDs on Amazon during Black Friday. Why would you allocate precious wafers, your silicon real estate, to low-margin consumer goods when you can sell enterprise-grade server memory?
Data center revenue is now 56% of total revenue. They're cutting the dead weight to fly higher.
You call it dead weight. I call it ballast. And I think this is a point investors are glossing over way too quickly. By discontinuing Crucial, Micron has effectively burned its lifeboats. Diversification is what saves you when the core thesis hits a wall.
But if the core thesis is strong, you don't need lifeboats. You need a faster engine. Every ship needs lifeboats. Consumer memory provided cash flow stability. It was reliable. It smoothed out the revenue when the enterprise cycle dipped. By exiting that market to go all in on the cloud memory business unit, they are making a leveraged bet on the AI ROI thesis. They are firing their most loyal, consistent customer base, the gamers, the PC builders, to chase a faceless data center client.
It is a bet on the future of computing. The PC builder market is shrinking. The AI market is exploding.
It is a concentration of risk. If data center buildouts hit a wall, and we know they are facing power constraints, needing 92 gigawatts of power by 2027 just to run these things, then that 56% revenue concentration becomes a massive liability. If the AI bubble bursts, or even just leaks a little, Micron has nowhere to hide. They don't have the retail consumer to fall back on anymore. They've locked the door and thrown away the key.
They don't need to hide. The demand for data center memory is structural, not speculative. But let's address your earlier point about the HBM technology gap, because I think you are misreading the situation with NVIDIA and the Rubin platform.
The market share numbers paint a pretty clear picture.
The current market share numbers reflect the past, not the future capabilities. Micron's HBM3E, the current generation, is 30% more power efficient than the competition. In a world where data centers are heat-constrained, where they are literally boiling the cooling fluid, power efficiency is the ultimate currency. That is why they hit an $8 billion run rate for HBM3E exiting fiscal 2025. That proves they can compete at the top tier.
HBM3E is the current generation. The market looks forward. The market cares about HBM4.
And looking forward, the setback on HBM4 is a temporary timing issue, not a technology failure. They are transitioning to the 1 gamma node. For the listeners, 1 gamma is just the next generation of extreme ultraviolet lithography. It's the method of printing the chips. It's incredibly complex. And they are utilizing advanced packaging from the Idaho facility known as Project Triton.
Which is still ramping up.
It is ramping, yes. They are targeting volume production for HBM4 by mid-2026. Being a few months behind SK Hynix on one platform does not negate the fact that the entire industry is supply constrained. NVIDIA needs every chip Micron can make. They cannot afford to rely solely on Hynix.
Needs is a strong word when SK Hynix holds 62% of the HBM market. And let's not ignore Samsung. After stumbling on HBM3E, they have secured 30% of the HBM4 orders for the Rubin platform. That leaves Micron as a challenger with roughly 21% market share. You are arguing for a valuation based on dominance, but the reality is they are third place in a three-horse race for the next generation.
A challenger with superior technology.
Superior technology that isn't qualified yet. Think of the qualification window like a launch window for a space mission to Mars. If NVIDIA is launching the Rubin platform in June and your chip isn't certified by April, you aren't just late. You missed the rocket. You have to wait for the next mission, which might be 18 months away. If they miss the volume ramp for HBM4, they miss the fattest part of the margin curve for the next year and a half.
I think you're overestimating the rigidity of that window. NVIDIA creates different SKUs, different configurations. There is always room for a qualified second or third source, especially one that saves 30% on power.
Maybe. But this connects to the capital expenditure risk. The industry is increasing CapEx by 80%. Historically, when memory makers increase spending this aggressively, it leads to one thing: oversupply.
That historical model is broken. The triopoly, Samsung, Hynix, Micron, is disciplined now. They aren't building capacity for market share. They are building for technology transitions. It takes more money to build the same number of bits because the tech is so hard.
Discipline holds until it doesn't. 80% CapEx growth is a massive amount of silicon hitting the market in 2027. If demand softens even 5% by the time those factories turn on, you have a flood of inventory and prices crash. That is the cycle. It hasn't gone away just because we call it AI now.
Let's talk about where that silicon is going and why the valuation could realistically hit $2 trillion by 2036. That is the 5x growth thesis. Because I think you're ignoring the demand side of the equation.
A $2.15 trillion market cap, that would put them in the same league as Microsoft or Apple were just a couple of years ago. Walk me through the math. How do you justify that?
It is a function of the total addressable market, or TAM. We are looking at the memory market hitting $430 to $455 billion by the 2030 to 2035 timeframe. From Micron to 5x, they need a 15% compound annual growth rate in net income. That is achievable because the drivers are diversifying, ironically, even as they kill the crucial brand.
Diversifying how? You just said they are focused on data centers.
It's not just data centers, it's edge AI. We are seeing flagship phones in 2026 requiring 12 to 16 gigabytes of DRAM to run on-device models. That is a massive uplift in bits per device. Then you have the automotive sector, which is growing at an 8.12% CAGR. Autonomous driving is a memory hog. A level 4 autonomous car is basically a server on wheels.
Auto is growing, sure, but it's a fraction of the volume compared to enterprise. It's nice to have, but it doesn't move the needle like a hyperscaler buying 1 million GPUs.
It's high margin, high reliability volume. And let's not forget storage. The Singapore NAND expansion, that $24 billion investment, starts outputting in 2028. That positions them to capture the storage side of AI training sets. The demand for AI is creating a vacuum for memory that spans from the server rack to the dashboard to the pocket.
The math requires perfect execution for 10 years. Let's deconstruct the risks in that decade-long view. You mentioned the Singapore expansion. That highlights a vulnerability: geopolitics.
They are expanding in the U.S. too. The CHIPS Act is fueling that.
Are they? Let's look at the reality of the U.S. expansion. Look at the New York megafab, the Clay campus. The timeline there has slipped significantly. Production has been pushed to 2030. They reallocated $1.2 billion in CHIPS Act funding away from New York to Idaho just to get the advanced packaging line running, that Project Triton you mentioned. That tells me that U.S. manufacturing expansion is much harder, much slower, and much more expensive than the PowerPoint slide suggested.
It tells me they are agile. They moved the money to Idaho because that is where the immediate need is for HBM packaging. That is smart capital allocation. Why build an empty shell in New York when you need packaging in Idaho today?
It's a delay, and it means they are still heavily reliant on Asia. Relying on Singapore and Taiwan partners remains a massive geopolitical risk. If anything happens in the South China Sea, that $2 trillion valuation goes to zero. But there is a bigger existential risk you are ignoring: technological displacement.
You mean MRAM?
MRAM. or compute in memory architectures. If we are looking out to 2036, we have to consider that traditional DRAM might be rendered obsolete for AI workloads. If a new memory paradigm emerges that solves the bottleneck better than HBM something, that uses less power and processes data right where it sits, Micron could be left holding a very expensive bag of legacy fabs.
That is always a risk in tech, but Micron is at the forefront of those R&D efforts. They aren't watching from the sidelines. They hold patents in MRAM. But let's bring this back to the present. You look at the stock today at 375, down from 455, and you see a falling knife. I see a company that is trading at a PE of 10 while transforming into the most critical infrastructure provider for the AI era.
And I look at a company that has had a magnificent run, nearly 300% in a year, but is now facing the reality of gravity. The easy money, the move from $60 to $455, that has been made. That was the recognition run. Now comes the execution run, and that is much harder.
The easy money, perhaps, but the structural money is just starting to compound.
My summary is caution. Micron is a great company, undoubtedly. But the risks of HBM4 delays, the sheer volume of competitor overproduction from that 80% capex hike, and the undeniable cyclical nature of memory suggest that the upside is capped. The stock is retesting resistance at 450 and failing. The real demand support, where the institutional safety net sits much lower, around 355. We aren't there yet.
And my summary is that volatility is the price you pay for owning a structural compounder. You cannot find another AI infrastructure play trading at these multiples. The shift to 68% gross margins is unprecedented in this industry's history. The inventory is sold out. They are building the clean room of the future in Idaho and Singapore. If you believe that AI is a decade-long trend and not a flash in the pan, then Micron is the bottleneck you want to own.
It depends on whether we are at the peak of the cycle or the foothills of the AI era.
Precisely. And that is where we leave it to you to decide.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.